Good morning, everyone. You are watching a live daily market outlook for Wednesday, 11th of April 2012, prepared by Windsor Brokers. Not much action seen during the Asian session, but some more movements we are facing now and the opening of European session as Euro and Sterling are slightly higher, but still the both instruments remain in the past couple of days neutral mode, moving within the narrow ranges and still without direction, as the risk appetite is slightly fading during these days. The upside still remains limited on both instruments, and keeping the recent recovery attempts still capped. From the other side, the yen is appreciating against dollar as risk aversion pushes the dollar lower, with the recent fresh low seen yesterday at 80.61 after the pair lost its that was our first downside target at 81 zone, also Fibonacci level, extending lower, and as all the studies are still negative, the further extension lower would be the likely scenario in the short term. The dollar Swiss also is within the range in past couple of days as from the middle of last week, so we're talking about nearly 1 week, but the pressure is still more to the downside as the upside stays well limited at 92.21, which is the previous high, and the downside range floor at 91.40 zone is now under pressure, loss of which would signal further weakness of the dollar and actually would abandon the current recovery attempt. The yellow metal is now back to strength after yesterday's sharp fall lower, when we lost some important supports. I think it was mentioned in our written technical analysis reports, but the support was found at 16.31. That was the low of yesterday, and the fresh strength is back now to the upper level 1663 seen so far on the late hours of yesterday, with positive near-term tone still keeping the upside in focus. More of this we will see on our technical part. Just to mention that crude oil remains under pressure, and yesterday's recovery attempts were capped at 102.80-90 zone. As if you remember, yesterday we mentioned that nothing below 103.40 would have more significant impact on the oil's price, and as happened, the two attempts at stalled just under 103 level, and the fresh weakness dip now posted the new low at 100.67, looking for test of our next strong support and psychological level at $100 per barrel, which we hope is going to break as the oil prices on petrol stations, petrol prices actually on petrol stations are too high everywhere in the world. So we are looking for a further decrease of the oil price. Talking about oil, Iran has cut as a reaction of on the recent embargo imposed by US and the European Union. Iran also took an action and cut oil exports to Spain, and also talking about possible stopping sales to Germany and Italy. Iran's English language state television reported yesterday in an apparent move to strengthen its position ahead of crucial talks with world powers later this week, but in an indication that Tehran's counter-sanction were of little impact. Spain's biggest refiner said it had already replaced Iranian crude with Saudi Arabian oil months ago. Iran has played a tit-for-tat game over crude shipments since the European Union decided in January to stop all Iranian oil imports as of July, part of a range of tough new sanctions aimed at forcing Tehran to curb the atomic work that the West suspects is part of a nuclear weapons program. The talks between Tehran and the six world powers aimed at easing the nuclear standoff are set to resume in Istanbul in coming Saturday, and could pave the way for an easing of sanction and might lift the threat of Israeli airstrikes on Iran. EU states have sought alternative oil supplies ahead of July's deadline, with Iran threatening to cut exports first, something Iran's press TV said was well underway. This I would say, game would lose the pace after the Saturday's meeting, as basically the most of excuses are given for high oil prices, as tensions between the Western world and Iran are increasing, and the possibility of war and so on, that will cause the disruption of supply of crude oil. However, if you remember in our couple of previous sessions, I mentioned that Saudi Arabia was in this story from the beginning, and from the beginning they said that there is no problem and there will be no shortages. They are ready to even to go to the full production, the full capacity production of crude oil, in order to cover any possible gap that might appear after sanctions imposed on Iran. And I think these steps are now keeping the pressure on the oil price, as it was unrealistically high, as many analysts agreed, and also oil producers, with the two blocks in the oil producers, one led by Saudi Arabia, that includes Gulf countries, and the other that are hawks in this group in OPEC, which are Iran, led by Iran, and the Latin American countries that are supporting the idea of very high oil prices. And at the beginning of this year, they announced that $200 per barrel would be quite suitable for them in this case, and good for oil consumers. The Saudi option, I think, is for now dominating, and increase the production of oil that covers any possible shortage, is resulting in the current lower prices of crude oil. Let's just take a brief look on today's calendar and see. Not much to be seen today. Australian home loans came during the night 2.5% negative release, minus 3 versus minus 3.6 consensus, and minus 1.2 previous result. Wholesale price index from Germany has already been released at 6 o'clock GMT. For some reason, we don't have update now. We're going to take a look. That came at plus 0.9% versus the forecast, the same forecast at 0.9%, and 1% of the previous release. Next to come is nothing more from Europe. From Canada, housing starts at 12:15 GMT. Unchanged forecast compared to the previous release of 201 units is in for today. Then from US at 12:30 GMT, March import prices that are forecasted to increase by 0.8% compared to a raise of 0.4% of the previous month, while export prices, also March reading, is expected to stay unchanged at 0.4%. The crude oil weekly inventories are due at 14:30 GMT, and build of 2.1 million barrels is seen for the last week, compared to this very significant one of 9 million barrels that was seen on the previous week. That is also signaling that there is no that significant problem in the oil supply, as much as it becomes now with the oil demand. As the stocks are building, it means that demand is going lower. The U.S. federal budget balance is due at 1800 GMT, and minus 202.5 billion dollars is the forecast of release for today, compared to the wider one of wider negative balance of 231.7 billion dollars, and late in the evening, Japanese March CGPI is due at 2350, 0.4% is forecast compared to 0.6 of the previous month, and the M2 money stock 2.8% compared to 2.9%. Quick look at the markets and the latest movements of major currencies and commodities. As usually, starting with euro, as we can see that the pair is stuck within the narrow range of 158 and 130.32 and 131.43. That was the high of yesterday, with studies relatively in the neutral mode on the hourly chart, as the upside remains capped at 131.43, and the more significant level, better seen on the 4-hour chart, is the 131.65 zone, where is the high of last Thursday. Also, we have the we have the 38.2% Fibonacci retracement of the down move from 133.80 to 130.32, and 55 days exponential moving average on the 4-hour chart, that is already pointing lower. So we need to see the break of this significant resistance in order to confirm the near-term bottom at 130.32 and open way for some stronger recovery on the upside with Fibonacci levels at 132 zone and 132.46, 50 and 61.8% respectively, ahead of the static resistance at 132.52 low of 29th of March 2012. Break of the range is our first required movement to signal further recovery. On the downside, immediate supports are at approximately 130.50 zone, which is the low of yesterday's low, and then we have 130.32. As shown on the daily chart, the studies are still more negative and more pointing to the downside, as the pair holds below the broken bull trend line of a yearly low at 126.25, which is currently at 131.65. Also, this is again at our stronger resistance, and the gain of this is required to, as mentioned, to improve the short-term outlook, while on the upside we have another at 132 zone strong barrier there, 55 and the 90 days moving averages, along with the trend line, main bear trend line resistance drawn of yearly high at 2011 27th of October high at 142.46, and only break above these levels, basically break above 132 zone is required to improve the larger pictures outlook and avert immediate downside risk. On the downside, the key supports 130.00 and 129.73, which is the past 2 months range floor, and the loss of these levels would significantly weaken the euro-dollar's structure. Confirm the tops at 133.84 and 134.85 and 133.84 in favor of further weakness and possible movements towards the yearly low at 126.25 posted on 16th of January 2012. The cable regained some strength during late yesterday's hours and overnight and this morning, but break above 159 handle off yesterday's low at 158.07. So 158 zone is now offering quite good support, and is basically the range, near-term range floor range of past couple of days. But upside action failed to clear the next very significant barrier range ceiling at 159.29 and 159.34, the 50% retracement of the down move from 160.61 yearly high, that bottom at 158 zone. So we need to see the break of this level in order to resume the current recovery, as the downside remains well protected for now. On the hourly chart, studies are still in the positive territory, but started, as we can see, the RSI is pointing lower, and the momentum is moving sideways compared to the recent very strong gains, while stochastics are also pointing lower, and most likely we are going to have the negative signal in this as the pair is quickly reversing off the day's high at 159.26 with loss of 159 handle to signal further range trading and movements within this 159.30, 158.00 range. On the daily chart, the structure is slightly improved as the pair managed to regain again levels above 200 days moving average that is currently standing at 158.42 and still holding above the main bull trend line at 158.20 along with the range floor at 158.00 that is offering quite good support for now. As studies are still pointing higher, we might see the further expansion higher as long as the first support at of 200 days moving average hold the downside. And likely targets, as mentioned, the initial one at 159.30 zone needs to be cleared. 159.64 comes next as 61.8 Fibonacci retracement ahead of 160.00, which is round figure resistance, and the 27th of March 2012 high ahead of yearly high at 160.61, and our main upside target. As long as 158.42 and 158.00 hold, there is potential of further attempts higher, with initial barrier at 159.30 needed to be cleared in order to resume higher. On the downside, loss of 158 opens immediate target at 157.69, and then comes 157.00. The dollar yen, as mentioned, is under pressure. I think it's better if we take a look on the daily chart, as over 38.2% of the 76 to 84.17 up leg has so far been retraced with 80.61 yesterday's fresh low. There was yesterday sort of consolidation above 81.20. Started actually on Monday 81.20, but the gains were capped at 81, limited by descending 20 days exponential moving average, as also the studies on the daily chart are firmly in the negative, and MACD is currently attempting to break below the midline. That will signal, that will confirm the negative structure and open way for a further reversal. Immediate support on the downside is 80.55, the higher platform of 80.56.57, the higher platform of 6th and 7th of March 2012, along with the 80.43.55 days moving average. Before we come to the 50% retracement that is standing at 80.09 with 80.00 as a round figure support, as well as low of 28th of February 2012, and these would be likely our next downside targets, with some corrective action, corrective attempt seen during the opening of European session, with the minor bounce higher to 18.93. Even 81 is still as round figure resistance, and the previous support is staying intact for now, ahead of next more significant 81.20 zone, the lower platform that was holding the downside during Monday and Tuesday before the fresh action yesterday that broke lower, ahead of also the next top of yesterday at 81.85. Basically, to improve the current structure, we need to see break of minimum 82.00, where is also the 55 days exponential moving average. That will ease the immediate bear pressure and likely open way for some corrective action, but the negative structure on the daily chart keeps the downside for now firmly in focus, and keeps the upside intact, as said. 82.00 in break of this level might allow for some stronger recovery. Very strong barriers at 83.40 zone are now capping firmly the upside, and the only regain of these levels would refocus, would confirm actually the higher low, and the refocus levels at 84 and 84.17. Dollar Swiss, similar to euro, is in past couple of days entrenched within the range as the recovery attempt of 90.00 base so far been capped at 92.21. This is the high of last week, 5th of April, and around here is the 61.8% retracement of the down move from 93.33, 15th of March high that bottomed at 90.00. The current movements are limited on the upside as set at 92.20, on the downside 91.40 zone, which is the range floor. This morning's fresh weakness as the hourly studies are still in the negative territory, dipped as low as 91.48, just close to our downside support and the target. However, the dips were so far contained as the pair is bouncing higher, but as said, the negative structure on the hourly chart keeps still the downside in favor, and only break above 91.75 and 91.90 would signal some fresh near-term strength. However, the pair is still in the rather neutral mode. On the 4-hour, studies are still negative and pointing lower with loss of momentum, keeping the downside more vulnerable, and the strong support as said 91.40 zone, where is also the 55 days exponential moving average is now our key near-term support. A loss of this level would sideline the current bullish structure of 90.00 that peaked at 92.21 and open way for a further reversal. 91.00 and the 90.90 are seen the next targets, and in case of firm break below 91.40. On the upside, as I said, 92.20 is key near-term resistance, and break here is required to signal an end of consolidation and the resumption of the near-term uptrend of 90.00 with the 92.50 before this 92.27, which is the main bear trend line drawn of yearly high at 95.93, along with the 92.32 90 days moving average and the 92.50 high of 16th of March 2012 seen as the next targets in case of a firm break above 92.20. Quick look at yellow metal recovery. As I mentioned in the introduction, the quick recovery was followed yesterday's sharp dip. When we mentioned in our written technical reports that the key support was at 1635 zone, the near-term range floor, and the loss of this level would trigger more significant losses. However, the dip was brief down to 1631, where the support was found, and the quick recovery followed breaking a previous high at 1654 and posting the fresh one at 1663 so far. Studies are back into positive territory on hourly, with the 4-hour chart studies also being positive as the pair broke clearly above 61.8 Fibonacci retracement of the latest down leg from 1683 to 1612, with the immediate barrier on the upside at 1665, trend line resistance, trend line drawn of 1697 high and connecting 1697 with the 1683 and the 1680 peaks, a break of which is to refocus our initial upside targets at 1680 zone, ahead of a more significant one at 1697 and 1700 as a psychological barrier. As said, the near-term studies remain positive and keep the upside in focus, while the immediate support is the yesterday's low at 1653. 1 second. Pardon, the overnight low at 1653, where is also the 20 days exponential moving average ahead of 1648, the 55 days one, where is also the main bull trend line drawn of 1612 low of 4th of April 2012. On the daily chart, positive signal is now given on the break of the main bear trend line drawn of 1790, high of 29th of February 2012. This is a 2012 year high also, and this might signal some stronger recovery, but overall outlook is still negative as the pair is in the sharp strong decline of 1790, with the 1612 low seen so far, as also the that retraced over 61.8% of the initial rally from 1522 that bottom that peaked at 1790. As said, the regain of 20 days daily moving average as well as main bear trend line might be signal for a stronger recovery, but still ahead we have a number of strong barriers to be cleared in order to confirm. 1680 zone is the first one, along with the 1697, 1692. 1692 is 200 days moving average, then 1697 is the previous peak, as well as 1700 psychological barrier. Clearance of these very significant levels would be signal for a further recovery of the yellow metal, and they will keep the downside levels at 1612 intact for now. Actually, that would signal the base at 1612 and open way for test of next levels at 1716 and 1725. That was all for today. We're back tomorrow morning at the same time. Wish you a nice day and very successful trading. Good luck.